partnership, number of the members will be, of course, more than one. If it's one, it should be a sole proprietorship business. If it's more than one, then we can call it's a partnership business. Now, what is the main difference between a partnership business and a public company? Or any difference? How could you differentiate? One is a partnership business, another is a public company. Public company means all those listed companies. They raise their fund from the stock market. Any difference? Can you mention any difference? Public company. Or which format of your business would be better? Yes, Kyle, please.
I was going to say, aren't certain things disclosed than one that aren't good?
Excellent. Yeah. So for public company, you need to disclose everything to your external users, investors, public, right, creditors. You need to prepare your fancy, beautiful annual report. You need to go to SEC's and Edgar filings. You need to prepare your 10K, right? Disclosure is really important. On the other hand, partnership, of course, you have to disclose, but it's enough to disclose only to your owners. You don't need to disclose it to the public, the whole country, the whole bunch of people, right? That's one difference. What else? What else? Or which format you would prefer? If you would like to invest, will you invest in a public company or in a partnership business? Public company? Why, Kyle? Why do you prefer a public company, not a partnership business?
Because you get to see all the financial disclosed.
Yeah, you will get all information. Well, if you invest in a partnership, you will also know it, because now this time you are a partner. Okay, any other reason? Any other reason? Which one you prefer to invest in? Public company or partnership business? I gave you $50,000. Are you gonna invest it? Yeah, what's up? Public, what's your reason? Okay, one reason is that you will get all the information, but again, if you are the owner of a partnership, you also have the right to get all the information. So once you invest in a public company versus in a partnership, both cases you will receive all information. Okay, so this slide, let's see. Which one would be your preference? Conrad and J and Victoria C. So I gave you $50,000 and I asked you to invest either in a public company or in a partnership. Which one are you going to pick? Public by Victoria. Less risky.
You'd have to put more into the partnership because you have to be a partner to get the business.
Right. You have to put more. Right. A small portion is fine. Very good. Excellent. 2 points. First, Victoria mentioned about risk. So if you invest in a public company, you buy $100 share, your risk is limited to $100. Right. If the company is bankrupt, you're going to lose $100. But if you invest in a partnership, you may have unlimited risk. So sole proprietorship and partnership, definitely risk is higher than the public company. Well, for partnership, we'll see there are different type of formats. Limited partnership, LLP, LLC, right? Limited liability partnership. But overall, of course, investing in a partnership is, of course, higher or more riskier than investing in a public company. Because if the partnership is bankrupt, then you are personally liable to pay off all of your obligations. Right. And also you mentioned here, Kyle also mentioned that your amount, right? If you invest in a public company, if you buy like $500 shares, still you are the owner. But for a partnership business, $500 is not enough to start your business, right? You may need to invest more. So that means if you think of the capital pool for a public company, you have this huge stock exchange and you can raise your fund, whatever the amount you need, right? On the other hand, for partnership business, you have a resource constraint. Right, it's only you, me, your brother, sister, cousin, friend, your partners, so they may have limited resources. Right, so here, if you look at the advantages and disadvantages, of course, you have both sides, but some other advantage I want to mention about the partnership business, which you will not get for a public company, is one is double taxation. So for public limited company, the corporations are paying tax, and if you receive dividend, this is also one sort of your income. You have to pay tax again. So your company is paying tax, and dividend earning is also On sort of income, you have to pay tax. On the other hand, partnership, you don't need to do this double taxation. Another important advantage for partnership business is that it is easy to form, it is easy to dissolve, it's less costly. But for a public company, if you need to do the IPO process, need to form this public company, it's a very complicated, lengthy process, and it's very costly too. And it is also difficult to dissolve the company. Right, liquidate the company. I'm talking about the public. So that means here, partnership business, if you want to think of a business, of course, owners will be 2 or more than 2. Right, and they have their specific act, partnership act. You don't need to follow the SBC gap, but of course you have some specific acts. You have to prepare your financial statements only for your owners, partners, not for the public. Right, but you will see here again, flexibility, it's easy to form. It's less expensive to form, it's easy to dissolve, and profit and losses, you all will enjoy your profit and losses. But on the other hand, for your public company, if you have thousands numbers of shareholders, you have to distribute all of your profit and losses. But again, one advantage, what Victoria mentioned, is unlimited liabilities, right? Well, we have several forms like LLP and LLC. You probably have heard that form. That have limited liability. And here, you know, the liability, if one of your partners, these 3 forms of partnership business, right? And at the end of the day, you see that you have to liquidate the business, and you owe huge amount of money to a bank or your customers. Sorry, not customers, or your suppliers or whatever the party you have to pay that, but we found that you don't have enough funds, and if one person is bankrupt, say for example Samantha is bankrupt, then you two are personally liable to bring your own amount to cover up that amount. So that means it's not only your liability, you may have to bear your partner's liabilities as well. Right, so here we will see different forms. If you read the chapters, you don't need to worry about reading all these terminologies. These are some format like subchapter is, they have highest 100 numbers of partners, LLP, LLC, LP. That means these type of definitions or formations, they limit the liabilities. For example, LLC, you could be a partner, you may have like limited liabilities, but you may not participate in any type of decision making of your business. Right, so these are kind of the background, but here starts our accounting part and we will focus on that. So we all are familiar with our traditional financial statements, right? Now who can remember what are the main 3 parts of a financial statement? I want to write here. So that's why, what are the major 3 parts? Tell me, financial statements. Any part? Come on guys, you have to talk, come on. No, any part of your financial statements. Kelvin, Victoria, Gianna. Balance sheet, very good. Let's start with balance sheet. What else? So thank you, Leon, you started. And what else? Any other part? Yes, Gianna. Very good. Income statement. What else? We do something in between balance sheet, income statement, and balance sheet. Yes. The statement of retained earnings, right? So you all are familiar with these 3 parts. So now try to understand or try to recall income statement lists what type of accounts. What do you show? Income statement. We show our revenues, we subtract our expenses. I'm not talking about multiple state complex income statement. It's like very simple, right? Very simple. You show your revenues, you subtract your expenses, you got your net income, right? So for partnership business, your income statement will be saying like this, exactly like this. And then here, what we do, statement of retained earnings, we usually have beginning balance, and then we add net income. We got net income from here, then we subtract dividend. This is how we got our ending balance of our retained earnings. Right, this is how your statement of retained earnings will look like. Now, how about balance sheet? We usually have 2 sides, assets, liabilities, and owner's equity, and and we all know that total assets must be equal to total liabilities and your stockholders' equity or owner's equity. And what we usually do, we take this ending balance here. Right, and this is how a traditional public company's financial statement will look like. This is a very simple format. But now here I'll show you how a partnership financial statement will differ. So when you are doing this partnership financial statement, you will prepare your traditional income statement. You will show all of your revenues and then subtract expenses. Then you will have net income. Now you need to prepare one extra statement. This is called allocation of income. Allocation of income. And you have to check how many partners are there. If you have 3 partners, you have to prepare 3 columns for 3 partners and a total column. And what you're going to do, whatever the net income, you will have some conditions and you're going to show how you are allocating this net income among these 3 partners. Right. So, once you finish your income statement, you need to do this new statement. That's what we are going to learn today. Right. This is called income allocation or allocation of income. Once you do this, you will do the statement of retained earnings, but you know what? We don't call it statement of retained earnings, rather we call it statement of capital. Statement of capital. Right. So again, this statement of capital is pretty much same. You will have beginning balance, you will have to add net income, but we usually don't call the amount what the owners actually take from your net income. We don't call it dividend, we call it withdrawal. So withdrawal is pretty much like your dividend. So you will have your beginning balance of your capital, then you have to add your net income, then whatever the portion of your net income you are taking out, we call it withdrawal. We don't call it dividend. And one thing you have to do, you have to prepare 3 separate columns for 3 partners. And when you are showing this net income allocation portion, you will show this amount here. Right. So, for statement of capital, and of course, under your stockholders' equity part, when you will show the capital part, you have to prepare separate column for separate partners. If you have 100 partners, you have to maintain 100 partners. Right. So, statement of capital is just like your statement of retained earnings. We will have beginning balance. We will add net income. We will subtract withdrawal, which is just like the dividend. This is how you will get ending balance. And you have to maintain separate column. And in addition to every partner's column, you will have a total column. Now, let's see how the balance sheet will look like. So the balance sheet, your asset side will be just like your traditional public company's asset sides. We will follow the liquidity order. That means we'll show all of our liquid assets first, like cash, account receivables, inventory. These will come first. Then we'll go to less liquid. Liabilities will also follow the same liquidity order. Most liquid liabilities will come first. I'll show it here. Sorry, Nick and Kevin and Noah couldn't follow it, so I am writing it here. So this is your asset side. It will be just like your typical public company. Liabilities will also be your typical public company, and for both cases we'll follow the liquidity order. Most liquid items will come first. Now how about this part? We actually don't call it stockholders' equity or owner's equity. We call it capital balances. Capital balances. And for each and every partner, you have to maintain separate capital accounts. And in addition to every partner's specific accounts, you have to show the total. So this side will be liabilities plus total capital. Total capital. So these capital accounts are really, really very important, and we're going to maintain And now from here, you will start learning this capital account. So, instead of writing owner's equity or stockholder's equity, which is usually one number, we will show this item, which we call capital balances, and for every partner, we'll maintain separate capital column, and of course, we'll show the total column. It's the same. One side total assets, and other side liabilities, and total capital. And here, whatever you will have this ending capital balance, we'll carry forward it here for every partner. So we have 3 partners, so this ending capital balance will be reflected here. And you will see from now, until you finish chapter 15, you will have several events, and that will affect these capital balances. And these capital balances are really very important. These capital balances actually is the equity portion. This is nothing but stockholders' equity, right? And whatever the profit and loss you have to allocate it, and you have to show it here how your capital balances are changing. That will reflect your capital balances. This is just how the capital amounts are changing, right? So, profit and loss will be reflected here. Withdrawal is nothing just by like your dividends. So, these capital accounts are really important. So, now here, let's see how you can form a partnership business. So, if you see the page that I gave you, I mentioned that it's a big one, right? So, you see that I made it red color in Italy, all red bullet points. That means these are the 4 items we are going to learn in chapter 14. Number 1 item is the formation of partnership business. That means initial capital contribution. When you are going to form the business for the first time, how could you contribute? Simple and straightforward. You could bring some cash and you could start the business. Right. This is how you usually do that. So here we will see how you could start your business. Right. How you could form the business. So again here, when I'm talking about the formation of a business, it is of course how you're going to contribute. So first, straightforward, simple way is to contribute cash. Let's see this example. Again, please, you will have journal entries. Those who are still not like feeling very strong about journal entries, please pay your attention. Because I know many students are good, but some students still don't know why it is debit and credit, or very basic things. Right, so try to understand it. These 2 guys, they started the business. Carter contributes $50,000. Green contributes $20,000. Straightforward. This is the very first day. 2 friends started the business. They brought cash. So what should be the journal entry? Cash increased, total 70,000, and you have to start their capital accounts, which is the most important account. That Carter's capital 50,000, Green's capital 20,000. Right, very straightforward. So how you could contribute to a business? First, you can bring cash. Is there anything else you can bring? Or you can contribute? Not only cash. How could you contribute? Yes, Nick. Yeah, you could give some land for your equipment. Right, you have a truck. So I can invest in our business. Right, so it's not only cash, you could also bring non-cash assets, right? So you could also bring non-cash assets. Now, let's see this example. This example, it says that the same two parties, they just started the business, and here, Carter actually invested cash. On the other hand, Green invested what? Green invested 3 property, non-cash property, inventory, land, building. What is the total value? So if you look at the book value, it's 55,000, but at the same time you can check the fair value. So now here, try to understand these assets are brought into the business. Assets are increasing. And who is contributing this? Green is contributing. So when we're going to record what is Green's contribution or capital, we will record definitely these assets. And remember, we'll record as per the fair value. This is one thing you have to remember. So what the journal entry will look like? Let's see. Right, Carter brought cash, 50,000. straightforward. Cash increased 50,000. Green brought these three assets. Right. So look at this. Three assets. They have book value, they have fair value, but we'll take fair value. We'll record all these assets as per the fair value. Inventory 10,000, land 11,000, building 46,000. So these are the assets we recorded. But wait a minute. Building that Green brought here, it has a mortgage liability. Right. Green owns a building and he's investing the building into the business. This is his contribution. But it has a mortgage liability, 23,600. So when you are bringing the building into the business, at the same time, you are bringing the liabilities. So you have to record the building, and at the same time, you have to record the liabilities. So you not only will record these three assets, but also you will record the liabilities. Because the building has a mortgage liability, 23,600. Right. Now check out what would be each partner's total capital. Carter is just straightforward, right? Conrad, you're here. Carter invested how much? Let's see. Carter invested how much? 50,000 cash. So this is straightforward. This is Carter's capital. Now, Jake, how about Green? Green invested what? Green invested? What number? What are the items? 55 or 67? 67. Green invested three assets. Should we record them as per the book value or fair value? Let's see who followed me. Fair value, right? Please turn, otherwise I'll feel like you're not getting it. Green invested three assets, right, Bianca? So you have to record it as per the fair value or book value. Fair value, right? Jake, fair value or book value?
Fair value.
Fair value. So total, it looks like it's 67,000, but the building has a liability. So what is his net investment? So you will see the net investment is actually 43,400. That means, of course, we're going to record all these assets as per the fair value, right? Inventory, land, building as per the fair value. And when we're going to consider Green's capital, look at that. How do we get this number? Because these are the fair value, that's fine. But at the same time, you have to subtract the liabilities. We also recorded the liabilities. So Green's capital is actually the net amount. Fair value of those assets minus liabilities, which is 43,400. Is it clear? How do we get this journal entry? Is this journal entry clear? Hi. Joe. Nick. You're following me, right? It's clear. So now we saw that you can contribute into your business. Either you can bring cash or you can bring your physical assets, non-cash assets. What else? Is there any other way you can contribute? Officially, you will always bring cash and physical assets. You can bring. Yeah, you could also bring that. Take it, right? You have some expenses. You could bring that. Definitely, that could be one intangible asset. And you can also bring your expertise. What do you mean by expertise? Say, for example, one of your friends is talking about, this is the tax season, and I say it takes like so long to do your tax filing. Yes.
I was thinking you bring like clients too.
Clients, right? So, and your friend, he wants to start a partnership business. He has some money, but he doesn't know how to file the tax. And you took tax class, you took the VITA thing with Professor Perry. He said, you know what, I have that expertise. Why don't you invest tax, and I will bring my expertise how to do the tax filing. And you can start your business. And you know all these people in the area, Bridgeport area, like client information, all of their phone numbers and emails. I'll reach them, I'll ask them, because we started this business, and please come here and we'll do the tax filing. So you could start a partnership business where not necessarily will invest cash, you can bring your expertise. Right. Because you are a CPA, you know how to do all these tax things. So when you are joining the business, this is of course one sort of intangible asset. Your expertise is an intangible asset to the business. Right. So here the third way to contribute the business is that you can bring some expertise. Right. or you can know all those client information, right? Or you know how to run the business. You have that degree, you have an MBA degree, you know how to run the business, but your friend has money, but he doesn't have any business knowledge. Right, so now how are you going to record it? There are two ways you can record it. One is called the bonus method, another is called the goodwill method. So now let's see the two methods. Right, let's see the two methods. First, look at this example. These two guys, they are starting the business, James and Joyce. They want to start an advertising agency. Right, James contributed $70,000 cash. Straightforward. Joyce invested only $10,000. But Joyce is an accomplished graphic artist. He knows how to do all these advertising things. He knows maybe Photoshop or all other graphic skills or softwares. He could do definitely the most part of this business. So this expertise is of course valuable to the business. So we'll consider this expertise as an intangible asset that Joyce is actually bringing in. And in total, what's the cash amount they invested? James and Joyce, total amount of cash. Nicole or James here. See.
80,000.
So they brought actually 80,000. That's the cash. But they had the deal that they will get equal ownership. Right. Although Joyce brought less cash, still they're happy. They will share the ownership equally because Joyce has other expertise. That's why James is happy. Even though James brought $60,000 more, still James is happy. So they will have equal ownership, equal capital balance. Now how are you going to record it? There are two methods. And for every problem, you have to read it carefully what method I'm asking. So first, see the bonus method. So bonus method, I mentioned that James and Joyce, they agreed that they will share equal capital amounts. They will share equal ownerships, 50-50. So James just mentioned that they brought together $80,000 cash. Now you need to distribute it equally. So we'll show James' capital is 40,000, Joyce capital is 40,000. Although Joyce contributed only $10,000, still they are happy because Joyce brought some expertise. That's why James will be happy to compromise. And here, actually, Joyce is receiving a bonus. The bonus is $30,000. Because Joyce's capital is 40,000, Joyce brought 10,000, so the difference is Joyce's bonus because of his skills. This is the bonus method. So again, look what's the total amount of cash. Split it equally because the deal is that they will get equal ownership. This is the bonus method. Now, how about the next method which we call the goodwill method? So here, whenever you will see the term goodwill, take a note, you have to recognize goodwill. Please take a note. Whenever you will see the term goodwill method means you have to recognize the goodwill. Recognize means you have to show or record the goodwill. So now here you see Joyce actually invested $10,000, which is $60,000 less than James. Still they are getting equal capital amount. Why? Because Joyce has some expertise which is really valuable for the business. Right. So now think of it. James brought $70,000 and Joyce thinks that he will get the same amount of ownership. Joyce brought $10,000. So here the difference is $60,000. So if they both claim that I will have same ownership, James 70,000, which is straightforward, this is his cash. Joyce says since we are having equal ownership, I will also claim the value of my capital is 70,000. Why is it $60,000 more? Because the expertise that Joyce brought values $60,000. So whatever the expertise Joyce brought, this is an intangible, of course, valuable property to the business, so we call it goodwill. So basically, here, Here, to make the capital accounts equal to James, that means 70,000. Here you have to check how much Joyce invested, 10,000. But he is still enjoying the equal portion, equal amount, which is 70,000. So the difference, we call it goodwill. So you have to record goodwill. Record means you have to do the journal entry. Record means recognize goodwill. Do the journal entry. So cash part is simple. We brought cash 80,000, 10 plus 70. Then we recorded this goodwill amount, 60,000. This is nothing. This is the value of Joy's expertise. This is the value of Joy's graphic arts skills, which is an intangible. We call it goodwill. And for the capital part, James' part is straightforward. James brought 70,000 cash. His capital is 70,000 cash. Joyce brought 10,000, we know, but he brought his skills in an intangible format. We call it goodwill. So you are showing the equal capital amount. Again, whenever you will see the term goodwill method, you have to be careful whether you recorded goodwill or not. So we recorded goodwill, and again, we showed the equal capital amount. So I'm wrapping up these things. We just finished our first bullet points. How do you form the partnership business? For your initial formation, how you can contribute. Look at this first bullet point. You can bring cash, straightforward. Cash will be debited, and whatever the cash amount you brought, that will be credited. Right. This is the cash contribution. You can bring some physical, non-cash, tangible assets. Right. Second case, we saw that land, building, equipment, truck, whatever, you can bring that, record all those assets as per the fair value. I'm repeating, as per the fair value. Check if there is any liabilities. Record that liabilities too. So this is second way you can contribute. You can contribute by bringing any assets, record all those, non-cash, tangible or physical assets, record all those as per the fair value. If you see any liabilities related to that assets, record that one too. Third way, you can also contribute by bringing in your skills, expertise, or some other things that will be valuable to your business. You need to follow either of these methods, bonus or goodwill. So bonus method, that means your capital amount will not be changed. You are not making the amount of the company higher, but you are splitting it, whatever the deal. On the other hand, goodwill method, you have to record the goodwill. Goodwill is an asset. You are creating one asset, making the company value higher. Right. And that's how you will see at the end of this recording, your company value is how much? Total assets is how much? 140, 80 plus 60. Total liabilities, they don't have any liabilities here. Total liabilities and capital is 140. Right. So initially it was 80-80 when you contributed it equally, but now here, since we recorded it goodwill, we actually are increasing the value of the company. Again, there are three ways. For this part, you just need to know the journal entries. And there is no like exercise problems. You need to know the journal entries from these PowerPoint slides. Now we're going to do the second item, allocation of income. Here comes the number part. So I actually erased it. Once you finish your income statement, you need to prepare this allocation of income statement. And we'll see two statements and we'll practice one problem. One is the allocation of income. Another is the statement of capital, just like your statement of retained earnings. And what I showed here, if you have three partners, X, Y, Z, A, B, C, you have to prepare separate columns. So now, when you do your regular partnership business, you are recording all of your revenues and expenses, you have your net income. Now you need to allocate the net income. Now there might be different conditions how you're going to allocate it. For example, here they can define a ratio. It is called PL ratio, profit loss ratio. How you going to share your profit? This is very important, PL ratio. If you have three partners, how you going to share it? 1/3, 1/3, 1/3, or 20, 30, 50. So definitely it depends on what is the deal. What is the MOU you sign? Right. So now let's check this example. Tinker, Ever, Chance. These are the three partners. They invested cash. 120, 90, 75. Evers will get 40% of profit and loss, and the two other partners, Tinker and Chance, they will divide the remaining 60% of profit loss equally. Right, that means if we have three partners, I'm writing Tinker, T is for Evers, C is for Chance. So what will be the PL ratio? Evers will receive 40%. And the remaining 60%, we have to divide it between these two partners equally. That means Tinker will get 30% and Chance will get another 30%. Right. So this is the deal. For every problem, look what is the PL ratio. What is the profit and loss ratio. That means how you're going to allocate your profit and loss. So this is their deal. Right. Three partners. So I just wrote it here. T is for Tinker, Evers and Chance. 30, 40, 30. This is the ratio. Now they have another condition. They're going to withdraw $10,000 cash annually from the business. Withdraw means it's just like a dividend. And they have this net income 60,000. So they finished. They completed their income statement. Net income is 60,000. Now our goal is to allocate this net income 60,000 following this ratio, and we also have these withdrawal things. Now, if I try to show it in a statement of capital, how will it look like? Definitely we'll practice some problems. Don't worry. So, again, the statement of capital is nothing. It's just the statement of retained earnings, but we are showing the capital balances. So you will have beginning capital balance, and I mentioned for every partner, you're gonna maintain separate columns. You will have total. Then you have to allocate the net income, and then they have drawings or withdrawal. So if I go back, what was the total net income? What was the total net income? I'm writing it here. $60,000. Take your calculator. We need to allocate it. This is the PL ratio. So Tinker will get how much? $60,000 is the total net income. You know the PL ratio. Tinker will get how much? 18,000. Evers will get how much? 40% of 60,000 is 24. Chance will get same, because Tinker and Chance, they have 30-30 ratio, same ratio. So we're going to allocate this 60,000 among these three partners, and we'll also give them this cash, which we call it withdrawal or drawings. It's just like the dividend. So this is how your statement of capital will look like. This is nothing. This is very similar to your statement of retained earnings. So beginning balances are given. This is actually given. For every problem, it will be given. Right. Now it is actually showing how your capitals are changing. This is the beginning balances. And you guys actually helped me to allocate this. We know the PL ratios. So Tinker got 18,000, 24, Evers 24,000, Chance 18,000. The deal was that everyone will withdraw $10,000. So we did it. This is how you get your ending capital balance. So you're going to show each partner, and we'll also show a total column. So this is how a typical statement of capital looks like. Now, we will do a little more. So they have this deal, whatever the income for every partnership business, they will have a ratio. They will follow that to distribute the ratio. They can have the deal to withdrawal. But sometimes you will see that one or two partners may work, just like the full time for the companion, they can get compensation or salary. Or they may have some conditions that they will get interest on their beginning capital. So if you see these type of deals are here, then we will follow all these conditions. We will fulfill all these conditions. If there is any condition that you have to give interest, we'll pay the interest. If you see one or two partners are working just like full time for the company, and you need to give salary, we will give them. And then after giving the interest, and after giving the salary, whatever the remaining net income, we will allocate that. Right, so we just in our previous example, we didn't have this type of condition. Now we'll see a little bit extended problem. We have this type of conditions here. This is the same problem, but they have new condition. Each partner will get 10% interest on their beginning capital. This is a new condition. And these two guys, Evers and Chance, they are actually working full time for the company, so they will get a compensation, $15,000. And you know the PL ratio is the same. Now, how are you going to allocate this $60,000? Remember, now this time you have to fulfill these conditions. Pay the interest, pay the compensation or salary, and then if you have any remaining profit and loss, we will split it. So let's see how it will work. So first we're going to pay the interest. You know the beginning capital. So we're going to pay interest on their capital. Right. So this is, we're going to pay interest. This is based on the beginning capital. So these are the beginning capital. 120,000, 90,000, 75,000. 10% interest. Very simple. So we paid the interest, then we paid the compensation. Now please look at this table and tell me the numbers. So first condition, you have to pay interest. That is your first obligation. So once you pay the interest, these three guys, based on their beginning capital, what's the total amount of interest you paid? What's the total amount of interest? Bianca, loud? 28,500. Then you paid the compensation because Evers and Chance work for the company. So each partner, because they are working, they get the compensation. What's the total amount of compensation you paid? Sure.
30,000.
30,000. So now tell me, what is your remaining net income? So your net income was 60,000. Then you must need to pay the interest. You paid that. Total you paid 20,500. For each column you will show that. Then you paid the compensations, which is 30,000. Can you do this little math? After paying this, what is your remaining net income? Remaining net income. Who can tell the number here? Remaining net income. Yes. Anyone? Use your calculator. Yes. Hi. Is it 2,000? 60,000 minus 28,500 minus 30,000. What is the remaining net income? Yes, sure. It's 1,500. So that means after giving the interest, after giving the salaries, your remaining net income is 1,500. Right? Now we're going to allocate this remaining net income following this ratio. We had this $60,000 net income, but we'll follow these obligations first. Right? These are our obligations. Interest and compensation. Then this $1,500 we will allocate. This is our remaining net income. And after following the ratio 30, 40, 30, Tinker got 450, Evers got 60, Chance got 450. That means we are allocating the same $60,000 net income, but we fulfilled all these conditions, and at the end they have different numbers. This is how we allocated the net income. It's called the allocation of income. And then you need to do the statement of partners' capital. The same thing, beginning capital, add net income, these numbers, then subtract withdrawal. Right. So, you know what? We will do some problems, but you want to take a break? Okay? You look tired. So why don't we take a quick break, then we'll solve some problems, exactly like exam type problems. Okay, so please get ready with your calculator, and we're going to solve exactly like the exam type of problems.